So there's a theory going around right now, and if you've spent even 5 minutes on crypto Twitter, you've probably seen it. The idea is that Bitcoin isn't already worth several $100,000, not because of lack of demand, not because of fundamentals, but because it's being actively suppressed. And according to this theory, the people doing the suppressing are the banks. Recently, a lot of that anger has been directed at JP Morgan. People are accusing them of shorting a company called MicroStrategy. Now, if you don't know what MicroStrategy is, here's the simplest explanation possible. It's basically a company whose main purpose today is to raise money so it can buy Bitcoin. That's it. At one point very recently, MicroStrategy's stock fell so much that the entire company was valued about $10 billion less than the Bitcoin it already owned, which meant that by buying the stock, investors were effectively buying Bitcoin at a discount. When I first heard that, I didn't really want to touch it. Blaming banks for price manipulation sounds like conspiracy territory, but I started digging anyway. And what I found led me down one of the most fascinating rabbit holes in financial history, something known as the debt spiral, sometimes called the death spiral. This concept isn't new. In fact, a paper published in a respected economics journal back in 2004 studied structures that looked eerily similar to what MicroStrategy is doing today. And what it found was unsettling. Many of the companies that used these structures eventually saw their stock prices collapse. To understand why, we need to zoom out, way out. In the late 1800s, the Ottoman Empire borrowed enormous amounts of money from French and British banks. The problem wasn't just the size of the debt. It was that the debt was denominated in gold. Then, in 1873, the world experienced one of the first major global financial crises. Lending dried up, interest rates spiked, and suddenly the Ottomans couldn't issue new debt to pay off the old debt. At the same time, their currency was weakening, and from their perspective, it looked like gold was becoming more expensive. But in reality, gold wasn't changing. Their money was collapsing. Eventually, the Ottomans defaulted. But the lenders didn't just walk away. Instead, they forced the creation of a new institution called the Ottoman Public Debt Administration. It was essentially a foreign, controlled body that took over tax collection and financial management to make sure the banks got paid. Fast forward to modern times and you see similar patterns. Greece borrowed hundreds of billions of euros, a currency it could not print. When its economy collapsed in 2010 and borrowing costs exploded, it couldn't repay the debt. The IMF stepped in and required Greece to create a special fund whose sole purpose was to seize and sell national assets to pay creditors. Different eras, same structure, and here's where it gets interesting. This doesn't just happen to countries. It can happen to companies too. In the early 2000s, regulators uncovered a financing structure that quietly destroyed hundreds of publicly traded companies. In 2001, the SEC began investigating a type of financing known as PIPEs, or private investments in public equity. Some of these deals included something even more dangerous called floorless convertibles. Here's how they worked. A struggling company needed cash. Traditional banks wouldn't touch them. So a hedge fund would step in and say, "We'll lend you money, and instead of paying us back in cash, you can repay us with stock. And if your stock price falls, no problem. We just get more shares." That adjustment mechanism created a perverse incentive. The lower the stock price went, the more shares the lender received. So lenders would hedge by shorting the stock. As the price fell, they were protected. Then they'd convert their debt into more shares and sell those shares into the market, pushing the price down even further. And the cycle would repeat. The SEC studied hundreds of these cases. On average, investors lost about 34% within a year. And this happened during a bull market. By the end of it, 85% of these companies had negative returns. Nearly half were delisted. That's the classic death spiral. Now, MicroStrategy is not using floorless convertibles. But the concern isn't identical mechanics, it's structural pressure, and that's what people are worried about. So let's break down what MicroStrategy actually looks like today. And fair warning, this is where it gets very nerdy. MicroStrategy is essentially a massive Bitcoin holding company with a small software business attached. According to their latest presentation, they hold roughly 650 Bitcoin. Depending on the day, that's around $59 billion. Those Bitcoin were acquired for about $48 billion, meaning they're sitting on over $10 billion in unrealized gains. They control roughly 3% of all Bitcoin that will ever exist. Against that, they have about $16 billion in liabilities. That gives them a loan-to-value ratio of roughly 11%. In traditional finance terms, that's extremely conservative. On the surface, it looks rock solid, but here's the catch. That $16 billion comes with a cost. Between interest on debt and dividends owed to preferred shareholders, MicroStrategy needs about $800 million per year just to keep the structure running. That's over $2 million every single day. And unlike common stock dividends, preferred dividends can't just be turned off. These investors bought what are effectively Bitcoin-linked instruments with guaranteed payouts. So where does the cash come from? The software business doesn't generate anywhere near that amount of free cash flow. So MicroStrategy created a separate cash reserve, currently about $4 billion. That cash exists solely to pay interest and dividends. At today's burn rate, it gives them roughly 21 months of runway without touching a single Bitcoin. Now we need to talk about something called MNAV. It stands for multiple to net asset value. All it means is whether the stock trades at a premium or a discount to the value of its Bitcoin. If MNAV is above 1, the stock is worth more than the Bitcoin it represents. That's good. In that scenario, MicroStrategy sells shares into that premium, raises cheap capital, and replenishes the cash reserve. But if MNAV falls below 1, everything flips. Issuing shares would mean selling Bitcoin at a discount. So they stop. Instead, they burn cash. And if that cash runs out, the only option left is to sell Bitcoin to pay obligations. That's where the death spiral risk comes in. Selling Bitcoin puts downward pressure on price. Lower prices reduce company value. Lower value makes selling stock unattractive, which forces more Bitcoin sales later, and the cycle feeds on itself. So why isn't Bitcoin at $200,000 already? You could argue there are two forces at work, one pushing prices higher through accumulation and leverage, and another incentivized to keep prices suppressed long enough to break that structure. This is where the JP Morgan narrative enters. The conspiracy version says banks are shorting MicroStrategy to force cheaper Bitcoin. I can't prove that. There's no hard evidence of a coordinated attack. What we do know is that JP Morgan has published extremely negative research on both Bitcoin and MicroStrategy. They've warned about index removal, refinancing risk, and structural instability. You could argue that creates fear, but fear alone doesn't prove manipulation. We also know hedge funds like Jim Chanos have openly shorted MicroStrategy, calling the model financial nonsense. Some people want this to fail, others are hedging, others are just trading price action. Put together, it can feel coordinated. But it's more likely a bunch of rational actors responding to the same incentives. So what happens next? Either the stock continues trading at a premium and the machine keeps running, or the premium disappears, the cash pile drains, and Bitcoin sales begin. That's the risk, that's the story. Personally, I'm still holding my Bitcoin, and honestly, the negativity makes me more bullish. If everyone agreed Bitcoin should be worth $1 million, it already would be. But I want to know what you think. Does the death spiral ever activate, or does the structure survive? Let me know in the comments. Smash the like button, subscribe if you haven't already, and bye-bye.